Hello all, this is Chartered Accountant Omkar Gadgil. So I welcome you all for the analysis of the GST provisions which is proposed in the Finance Bill 2023. As you all know that today on 1st of February 2023, the Honorable Finance Minister presented the budget and Finance Bill 23 was tabled. By virtue of the said bill, there are certain amendments which have been proposed under the GST law, and our emphasis would be to discuss the amendments which have been proposed under the goods and services tax laws. So what we have tried to do is we'll try to cover the provisions as they were in the existing scenario, the proposed amendments and the analysis that we wish to discuss basis our study so far on the provisions. So on behalf of the Gadgil and Associate Chartered Accountants Tax-wise Advisory Services, as I happen to be the Senior Consultant, and also Mrs. Kavya and Company Chartered Accountants, I welcome you all for this discussion. Let's proceed with the discussion with the first part of our analysis that starts with the provisions which are relating to the composition levy. Now, as far as this current scenario goes, under the composition levy for supply of goods, there was a limitation that a taxpayer who is registered under composition levy and who is engaged in the supply of goods, he was not allowed to continue or enjoy the benefits under the composition levy if he was supplying or he was to supply any goods through an electronic commerce operator. Now, in order to rationalize this entire scenario, there is a welcome measure which has been adopted wherein a composition taxpayer or the person who is registered under section 10 subsection 2 of the CGST Act as well as 10 to AC, who is engaged in the supply of goods and who has opted for the composition levy, and if he wishes to make the supply of goods through an e-commerce operator, he can still enjoy being under the composition levy. So that limitation which was there earlier has now been done away with. The next is in respect of input tax credit eligibility provisions which are laid down under section 16. Now, particularly this amendment is in inclination to the proviso to section 16 subsection 2. Now, there are two parts to this proviso. The second proviso talks about if the payment is not made to the vendor within a period of 180 days from the date of invoice, then the amount which is equivalent to the input tax credit and the amount of invoice including the tax credit thereon, if it is not paid to the vendor within a period of 180 days, then earlier the provision was worded that in such a scenario the amount shall be added to the output tax liability along with the interest in such manner as may be prescribed. Now the proposed bill says that the words are replaced as that the recipient shall, that if such amount is not paid within a period of 180 days to the vendor from the date of invoice, then the amount shall be paid by the recipient along with the interest payable under section 50 subsection 1 in the manner as may be prescribed. Now here the words shall be added to the output tax liability have been changed to shall be paid by the recipient along with interest. Now per se, by a plain reading, it is possible to say that okay, it has been only aligned with, and even as the notes to the finance bill say so, that this provision or this amendment has been done only to make it in alignment with the return filing mechanism which has been laid down in section 39, that is GSTR 3B. The only thing what we had a particular point over here is that there is one emphasis which is being put up through this provision now, that earlier in the GST audits also this point has been certainly pointed out a lot of time by the authorities, wherein the taxpayers have defined or rather defended the ground stating that the payment was not made to the vendor within 180 days. However, there was no reversal of input tax credit also that had happened. Only in such case, if subsequent payment was actually made to the vendor, then interest is something that was only accepted as a component and interest was being paid, or rather is being paid right now as well. Now this provision which is now worded as that the recipient shall be paid by him along with interest payable thereon. Now we have a set of belief over here that when it says that it is paid, it is to be paid along with the interest, it has some definite push wherein the taxpayer is bound to pay this amount and not just make it as a part of the return liability, meaning thereby it is now getting a bit certain that in the event of non-payment within 180 days from the date of invoice, it's a emerged liability and that has to be paid immediately along with the return for that particular tax period which will be filed in the next month. And therefore, along with getting it in alignment with the provision of return filing, we also feel that there is a hint of emphasis that has increased with respect to this provision. So that is some point which we feel is relevant from discussion perspective. Now, the third proviso to the said section says that provided also that the recipient shall be entitled to avail the input tax credit on payment made by him towards the amount of value of supply of goods or services or both, along with the tax payable thereon. Now, the words which have been reverted as the provided also that the recipient shall be entitled to avail the credit of input tax on payment to the supplier. Now, here the words used are payment made by him for the amount towards the value of supply. Now, it has been reworded as input tax on the payment to the supplier of the amount towards the value of supply of goods. Now, here what we wish to just dissect for a moment is that till now the worded provision was that the payment has been made towards the supply of value of goods and the tax thereon, or the value of supply of goods or services and the tax thereon. Now it is specifically payment being made to that supplier has been emphasized. Now here there is a possibility that if at all, let's say there is a scenario that there is a vendor whom I am paying, and if he tells me that okay, instead of paying me money, you pay it to some third person to whom I am liable to pay money. So if I am making a payment to that such third person and making an account adjustment with my actual vendor, then will it be amounting to payment made to my supplier is one thing that needs to be taken into consideration. Also, we have one more scenario possibly which we have examined today, right? If let's say that in respect of a purchase that I have made from a vendor where I have not made the payment within 180 days, let's suppose. Now if in the event I am supposingly receiving a DRC 13 from the department saying that okay, that vendor is a defaulter and the tax which is to be paid or the amount which is paid to him, that shall be deposited with the government by virtue of this DRC 13. Now if I make such payment through DRC 13 directly to the credit of the revenue, whether I will be entitled in such case to re-avail this input tax credit, and even let's say in case of a insolvency bankruptcy court procedure which is going on with the vendor who is a defaulter, let's say, and he is now gone into liquidation. Now if the official liquidator has raised a demand wherein I am supposed to pay it to the liquidator and not to the account of the vendor, then will it also amount to payment, and in all such cases will my reclaim of credit will be in a jeopardy. So that is something that needs to be pondered upon, or rather we think that there has to be some clarification in this regard also which should become. Now we move further, we talk about the restricted input tax credit. Now this provision is specifically in relation to the explanation that has been given in section 17 subsection 3. Now particularly when this provision is invoked, so let's say that there is a commonly consumed input tax credit for goods or services, and where there is a reversal of the commonly consumed credit towards the attributable exempted supply which is done under rule 42 or 43, let's suppose. Now in such scenario, the exempted supplies will normally include all the exempted supplies or non-taxable supplies for that matter. However, in a specific case under section 17 subsection 3, there is an explanation that for the purpose of this expression, exempted supplies shall not include the value of activities or transactions which are specified in schedule 3, that is the transactions which are neither supply of goods nor supply of service, except those specified in paragraph 5 of the schedule 2. That is, in case of construction services, we know that in case to the extent of the immobile property sale, we have to consider it for the purpose of reversal. Now in addition to that, there is also a paragraph 8A which has been taken into consideration for this, meaning thereby, in case of supply of goods from one bonded warehouse to another bonded warehouse, that is generally called as a bond-to-bond transfer. This transaction is there and is a part of Schedule 3 transaction. We all know it was added since GST Amendment Act 2018, that is with effect from 1st of February 2019. However, right now as we see that there is a issue now that this provision which is proposed over here says that I have to consider Schedule 5B transactions of Schedule 2 for this exempted supply, as well as the turnover which is pertaining to this bond-to-bond transfer. I need to consider that as a part of this supply. So here there is a scenario that my reversal under Rule 42-43 is going to increase because of the inclusion of turnover of bond-to-bond transfers as a part of my exempted turnover. However, there is something to note that in case of IC sales as it is there in part 8b, and in case of paragraph 7 which talks about the out and out supply, that is, let's say that buying from Vietnam and sale in Japan and you are sitting in India. Both of these transactions are also there in schedule 2. Their values are not to be included for this calculation of exempt supply. Only as an exception, earlier it was limited to that paragraph 5b of schedule 2. Now it also includes 8a of schedule 3, which value should be included in the exempted supply quantum. So this is something that we are going to coming across this aspect, which will cause a widening of the amount to be reversed by virtue of this rule 42 and rule 43. Now, the next that we are going to discuss is one very important amendment which is now going to crop up is regarding the block input tax credit. Now, block credit, as far as the block credit goes, we are having particularly this issue when it comes to block credit, because in general the block credit are very much disputed, and as much as the tax authorities are auditing the books or they are going for the scrutinies, the block credit disputes are increasing day by day. Now there is a new clause which is inserted FA in section 7, which is proposed to be included in section 17 subsection 5, which says that if the goods or services or both are used by a taxable person which are used or intended to be used to meet the obligation under section 135 of the Companies Act as a part of the CSR activity. Now 135 of the Companies Act which makes it mandatory to the companies which are operating as a company under the Companies Act to have the CSR contribution or the CSR activity or the CSR spending or expenditure as a part of their company's operations. Now, so we are saying that if any goods or services are used by a company and distributed as a part of the CSR activities, then that will not be eligible for claiming the input tax credit. So now let's say that there is a company, say Bata Limited is distributing slippers and chappals to the people as a part of CSR activity without any cost. They are not distributing it as a free gift or a sample, but they are doing it as a part of CSR initiative. Now, since that is an obligation under section 135, to the extent of those freely distributed slippers and chappals, the input tax credit will not be eligible. Now here the only thing that we see, there's a possibility that a proprietary firm or a partnership firm may just crop up and say, okay, we are not under the obligation under the section 135, then is really clause FA going to bother us? If we do a CSR, then is it going to disturb us? Now the only thing is that there is a precedence under the pre-GST regime where there are some judgments which are in favor to the extent that the Senvat credit was permitted in case of certain companies or certain taxpayers if the goods or services were used for CSR activities or for the donations or any of such nature. Now, if for CSR initiatives, if the Senvat credit was allowed maybe at the lower courts in the pre-GST regime, there is a possibility that precedence would be set, and in the GST regime also people would have inclined to take the credits on the same lines. But I believe this really puts a dead end to that there will be no further discussions. As far as goods or services are used for CSR initiatives, the credit will not be allowed. Yeah, as I said, the proprietary firms and partnership firms, they do have some possibility of getting something out of this, that they may still claim up the credit, but of course that will be definitely litigative and more likely that it will be very aggressive position to adopt. As far as the registration provision goes, the next amendment has been proposed, section 23, which talks about where the scenario where there is no need of obtaining registration, the following person shall not be liable to the registration, namely. Now this provision in section 23 initially was starting with these words, the following person shall not be liable to registration. Now this provision has been reworded to start with a non-obstant clause saying notwithstanding anything contained contrary to in section 22 subsection 1 and section 24. 22 subsection 1, as we know, it is a provision regarding the mandatory registration under the law, where it says that if a person is engaged in making any taxable supplies and including the exempted supplies, etc., that is the aggregate turnover, if it exceeds 20 lakhs or 10 lakhs in the specified areas, then he is required to take a registration for each such premises or each such place. Now, whatever has been mentioned in 22 subsection 1 or 24, irrespective of that, in a scenario if that the taxpayer is engaged exclusively in supplying exempted goods or services, if he is an agriculturist to the extent the sale of cultivated products from the land, or any other notified category by the government wherein there is no need to obtain registration, in all such cases there will be no need of taking any registration even if whatever has been mentioned in 22 subsection 1 and 20 section 24. Now friends, we have one point to ponder upon here is that now in 24 there are the provisions regarding compulsory registration. Now one of the aspects is that if the taxes are to be paid under the reverse charge basis, then mandatory registration is there irrespective of the fact whether you have an aggregate turnover or not. Now let's suppose that the reverse charge provisions are being, the provisions are by virtue of the notifications issued under notification 13 by 2017. These notifications are under section 9 subsection 3 of the GST Act, which is the provision for levy of tax. Now there the provision says that in case of 9 subsection 3 transaction, the recipient shall step into the shoes of the supplier. Now in one of the reverse charge provisions it says that if the services are provided, let's say goods transport agency for that matter, if it is provided to a company or a society or a firm, then the reverse charge is applicable to the recipient. Now my thought process over here is that applicability of levy of tax under reverse charge is not qua the status of taxable supplies or non-taxable supplies by the recipient. It is qua the nature of entity of the recipient, being a firm or a society or a LLP. And therefore, whether 9 subsection, because this provision has a limited overriding clause which says that notwithstanding anything contained in 22(1) and 24(1), in section 24, there is no need to take a registration, fair enough. But if that 9 subsection 3 provision is going to override over here, because there is a mandatory tax payment, if the GTA is not registered, if the notification of reverse charge is making the recipient liable to pay tax, and if the recipient falls under any of the section 23, then which provision is going to really get an overriding impact over here? Then if tax payment gets established, then it is either the supplier or the recipient who has to pay the tax. But if neither of the persons are registered, then in that case it will be like a transaction which was otherwise liable to tax but on which there is no tax collected. So let's say that one may just equate it with the scenario that okay, there is a Pani Puri vendor on the roadside and he is selling Pani Puris which is otherwise taxable, but because his turnover is below the threshold limit, he is not paying any tax, the consumer is not paying any GST. So this might just end up on these lines that okay, there is a tax payable, there is a levy, however because of the limitation of the registration provision, there is nobody who is going to pay the tax. Maybe that is one way in which this can turn out. So this is something that can be really discussed about, or this can be debated, and even there is a possibility that the authorities may come up heavily as far as the reverse charge aspect is concerned. Now returns under GST, there has been a change which is bit of a different nature. I mean this change, because why I used to say it's in a different nature, because it is giving a limiting factor for filing the returns of a particular tax period for a period up to 3 years from the end of the tax period, and even in exceptional scenarios that 3 years period can also be extended. Now the thing is that if it is about GSTR 1 or GSTR 3B which is permitted to be filed after a period of 3 years as well. Now in a practical scenario, until and unless we file the tax period return for one tax period, the return for the next tax period cannot be filed, that is known. So probably we are trying to envisage the scenario that if somebody has discontinued filing of returns, there was a suspension of registration or a cancellation of registration, and then subsequently there is a revocation. Now in such case all the previous compliance is required to be done, and in that case you are required to file all the pending returns. So if that is the scenario, then okay, there is the possibility that okay, if a business is discontinued for a time period and then it is wanting to resume it under the same name or numbers, etc., and if that provisions are permitting, then this 3 years time period can be very well used. Now also there are some notices right now we are having which are about the 2A 3B differences, wherein it says that if the supplier has filed his return after the due date of claiming credit under 16 subsection 4. Now in principle I really do not feel that it is agreeable enough to say that okay, in such a scenario you need to pay the tax, however, or rather you need to reverse the credit, because 16(4) is the time limit for availing input tax credit and not for filing of GSTR 1. However, let's say that for a particular financial year, the time limit for filing GSTR 1 is now permissibly allowing you 3 years timeline after the actual due date of that return. And then if the return provision makes it allowable to file the return, then will the limiting factors of input tax credit also be worked up, because then it will be like a double tax scenario, that supplier is actually okay filing his return after the specified date or after the due date, but the recipient is willing to claim the input tax credit. Then will he be allowed to claim the input tax credit in such subsequent period, because then वो 2B में आएगा and he'll be able to see that as an entry, then will it be really allowed? So this is something that needs to be clarified by virtue of the circulars or notifications in this regard, that how exactly this 3 years timeline is going to be helpful for the taxpayer. Now likewise, in case of the annual returns, it is allowed to be filed up to a period of 3 years from the date of the due date of the annual return. Now at least for the last 1 year, we have seen that there has been no extension in the due date of annual returns, and whatever are the due dates are followed. And likewise, 31st December being the due date for a particular financial year, then 3 years from that due date period or that due date date particularly, you are allowed to file the annual returns, and that is what has been proposed in the finance bill. Likewise, the submission to be made by the TCS deductors, or the TCS collectors by the e-commerce operators. They will be also allowed the time period of overall 3 years timeline to file those claims or to file those statements under the section 52. Now we come to the next part of the discussion, that is about the amendments proposed under refund. Here not much of a difference has actually been caused. It's just that there was a provision regarding the elimination of provisional input tax credit under section 41, which was originally laid down under the law. Likewise, the refund to the extent it related to the provisional credit was to be reserved. That was the provision earlier. However, now since that provisional accepted credit as such only doesn't exist, the provisional limitation on the provisional quantum of refund is also not going to be exist anymore, and therefore we today are going to see a scenario that okay, the refund will be allowed on the basis of the input tax credit which is available on a self-assessment basis. Of course, there are conditions under section 16(2)AA to match it with the GST 2B, so that will always be given an emphasis while the refund authority is going to issue you the refunds. Now, the next aspect is about the interest on the refund, the interest payable on the refunds. The provision till now also said that the interest was payable if the refund was not paid or the refund amount was not given within a period of 6 months, within a period of 60 days from the date of application, receipt of application. Now it only says that the interest would be paid if the refund is not given within 60 days from the date of application of refund. However, there will be certain rules and regulations which are further laid down in this regard as to how the calculation of this interest would be done, on what quantum it would be calculated. So there will be rules and regulations which will be brought in this effect. So that is what the updated version of the provision only says. Thereafter, a certain relief has been granted on the penalty provisions. However, now this penalty provisions which are there, particularly in section 122, there is an insertion of a new penalty provision, especially for the e-commerce operators. So if the e-commerce operators are allowing unregistered suppliers to do business through their portal, or if they are allowing the business entities to do business through their portal, who are not permitted to otherwise do the business under the GST law, or who are not declaring their business under the GST law, then it is the e-commerce operator who would be charged with a penalty in case of such offence. That has been brought in by virtue of the section 122 amendment in this finance bill, which is in section 122(1)(b), which will be an insertion. Now here, particularly if we see, it is the supply of goods or services through an unregistered person other than an exempted person who has been exempted from registration by a notification under this act, or he is allowing, that e-commerce operator is allowing an interstate supply of goods or services or both by a person who is not otherwise eligible to make an interstate supply, because as we know, interstate supply of goods is a mandatory criteria for registration under section 24. So if some e-commerce operator is permitting a business to make an interstate transaction without actually letting him get registered, then it is the offence on the part of the e-commerce operator. Further, if there is any scenario that if he fails to furnish the correct details in the statement to be furnished under section 52, means the TCS declarations, if it is not made properly, even in such case the e-commerce operator is going to face the heat of this penalty and offences. A section dedicatedly being inserted for the e-commerce operators is sort of an alarming sign for all the e-commerce operators, because then they have to be exclusively vigilant about such transactions wherein the vendors are either not registered or they are doing an interstate supply when they don't have any registrations, or in a scenario if the e-commerce operator fails to file the statement of TCS within the permissible time limits. Decriminalization has been a lot in the buzz for discussion, that a lot of arrests, a lot of raids and all the activities have been taking place of late. Of course, there are precedences which have been created by the fake invoices or the fake input tax credit or supplies without actual supply of goods or services. And there was a need felt among the business that okay, there needs to be an environment not of fear, not of fear and lot of trauma, because there was a series and chain of arrests which was being made, or a series of all the prosecutions which was being made, and in order to just rationalize it to a certain extent, I would say, not very completely, rationalize to a certain extent, the offences which have been now section 132, which envisages the punishment for certain offences, it has an impact now after the amendment which has been brought in, that there will be a decriminalization of offence under the specified clauses. Specified clauses as in not in every case all the relevant criminal proceedings are going to be, or the prosecutions are going to be initiated. That is the first point. For initiation of prosecution, the limit has been increased from 1 crore to 2 crore rupees, or proposed to be increased from 1 crore rupees to 2 crore rupees as a evaded amount of tax or the dues which are there under the law. Now here, the only thing is that if we see that this aspect has not, this aspect is not going to specifically cover one scenario, that where there is actually a supply taking place without any goods or services actually being given, those clauses have not been eliminated. So there is going to be an offence and rather a punishment in such case if there is a fake bill circulation or if there is a fake transaction. There is no relief in such cases. There is no relief on the criminal scenario of criminal side of the punishment to that extent. However, there were some minor scenarios as a part of the clause to section 132 which have been taken into consideration. Now, as far as the compounding of offences is concerned, now compounding per se till now probably people have not reached the compounding level. However, if there is the compounding of offences, to the extent that compounding will not be permitted if there is a transaction wherein there was a transaction of purely bill sale and there was no goods or services involved. So in such cases, there will be no compounding of offence which is allowed if there is an offence of a nature of supply of goods or service without the invoices. Or if there is only an invoices, there is supply of only invoices but there is no goods or services really involved, that offence will not be eligible for compounding. Thereafter, there is the provision which has been newly inserted, which is proposed to be inserted rather section 158A, which talks about the sharing of data and information. Any data or information that the taxpayer is uploading on the GST portal for registrations, for filing of returns, while filing e-invoice, while filing e-way bills, etc. Any such information which has been updated on the portal, on the common portal, that portal reserves the right to share the information as and when to the dedicated channels which are laid down by the government or by on the recommendation of council wherever required. So probably with the banks, with the income tax department, with any other, let's say, ED authorities or with any other authorities which are prescribed by the government, the information sharing from the common portal is going to be allowed to these institutions which are specifically covered by the notifications and circular issued time to time in this regard by the government. So here, of course, this opens the window for the cross verifications of data. Till now we have been getting notices on the basis of the TDS data. We used to get notice under service tax. Now these cross mechanisms are going to really open up the gates for the verifications for genuineness of or the end-to-end of truthfulness of a transaction. With respect to the Schedule 3 transactions which are there in paragraph 7, that is about the out and out supply, the paragraph 8A which talks about the bond to bond transfer, or the scenario of, you can say, this high C sale which is covered in paragraph 8B. These were introduced in Schedule 3 with effect from 1st February 2019, that is GST Amendment Act 2018 के साथ इनको introduce किया गया था. However, we were having certain challenges also during the audit that were happening, that the authorities were challenging that okay, if they were brought in with effect from 1st February 2019, then for the period 1st July 2017 to 31st January 2019, ideally these should not be Schedule 3 transactions, so there should have been a tax paid in this regard, or there was a case of common credit reversal which was being demanded. Now we always had a legal defense to this, saying that the Customs Act prima facie had covered these transactions not to be taxed in the initial hands. These notifications under customs were issued back in 2017, June 2017 only. Customs has issued notifications about the bond transfer and the high sea sales. However, now these transactions have been legitimized with effect from 1st of July 2017 with a retrospective impact that any high sea sale, bond-to-bond transfer or out and out supply will not be considered as supplies with effect from 1st of July 2017 itself. Now, there is a catch over here that if there are any taxes paid from 1st July to 31st January, let's say, even unfortunately the refunds which are being possibly to be taken, that we may say that okay, since these transactions are now retrospectively considered as not supplies at all, and if you have paid any taxes, we should be getting a refund. There is a specific refund debarring provision which is also proposed along with this. Now, as we discussed earlier, that exempted supply basis has been extended to include the transactions of bond-to-bond transfer. So there is a problem now if the Rule 42-43 assessments, if this inclusion of 8A is retrospective by any chance, then there is a challenge that the Rule 42-43 reversals may be demanded on a higher turnover basis for an earlier period. So of course we do expect that this has to be, the amendment we discussed earlier should be in a prospective manner, so that there is no confusion to that extent which is going to be created. Alright, and in the lateral part of the discussion, so as far as the place of supply provision goes, the place of supply provision in section 12 subsection 8, where there was in the initial time the place of supply under section 12 subsection 8 read only this much, that the place of supply in case of transportation of goods, by way of transportation of goods, in case the services were provided to a registered person, the location of such person is the place of supply. If it is provided to a person other than the registered person, then the place where the goods are handed over for the purpose of delivery was the place of supply. There was no proviso in the initial scenario. Then there was a proviso inserted which said that if the ultimate destination of goods was outside India, then the place of supply shall be such destination of goods. Now in such case, since the place of supply was falling outside India, in most of the cases wherein there was a overseas transport of goods, there was relief or exemptions to the extent possible in such scenarios. Even under the cases where there was an exemption which was existing till 30th of September 2020, 31st of October 2022, that there was an exemption by way of this applicability of tax if the destination of the goods was outside India. However, that exemption was withdrawn, and likewise this particular proviso has also been taken out. Now all these transactions, let's say an Indian shipping company is taking the goods of an Indian customer from India to Dubai, still that transaction would be liable to GST because there is no proviso otherwise to determine the place of supply. So if it is an Indian company for whom the transaction is being made, place of supply will be the location of such company, that is the registered location of such company, and in such case there will be no relief from the applicability of tax in such case, because the proviso has been specifically eliminated, and therefore we cannot really say that there is any relief now possibly available in that regard. There is only one change which has been also proposed in the online information access database retrieval services related definition, non-taxable online recipient. The definition now stands to be recorded as non-taxable online recipient means any unregistered person receiving online information and database access or retrieval service located in the taxable territory. Earlier, the unregistered taxable was this particular definition was broadly saying central government, state government, local authority, and any individual who is a non-resident. Any individual who is a non-registered person. Now, the non-taxable online recipient meaning has been limited to only any unregistered person receiving an online information and database access retrieval services located in a taxable territory. Now this particularly is only limiting that arena. However, the taxability in this regard definitely exists. It is only talking about in which case the OIDAR provisions which are envisaged in section 13 would be made applicable in such scenarios. So, friends, as far as that provisions are concerned regarding the place of supply, the IGST Act only had these limited amendments. Based on this, our analysis to the extent of provisions which have been proposed under the GST law is now coming to an end over here. We have also prepared and circulated this compilation across to you. So we definitely hope that if you have any questions or any queries to discuss, of course we can have a mutual discussion to that effect. Of course, given the fact that since the budget has been introduced today, this was only an effort which was made from our side to analyze the provisions in accordance to what limited knowledge we have with respect to this law. Of course, this law is, even though 5 years down the line, it's still 5 years older, but still there are a lot of differences of opinion and there are some parallel views which are there, which are obviously welcome and which are very much open for discussion. So on these lines, I, Onkar Gadgil, wish to take your leave for the while. I thank my entire team today at the offices who have really worked hard and given their time, heart and soul for this compilation. I thank them all. Thank you so much, all of you. Take care. Jai Hind.